Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, March 31st, 2021, and I'm pre-recording this Trading Places Live for Thursday, April 1st. Futures are currently pointing to an extension of Wednesday's rally, with the NASDAQ showing a bit more relative strength in the after-hour session. But it is still early, of course. We've got the overnight hours to go, so it's hard to say where we'll be come Thursday morning. But I do know it's going to be April. And for those of us like me at Earnings Beats, we will not miss March. We do follow and trade many of the growth stocks, and it was not a kind month for growth investors, much more so, much better for value investors. I think that'll change as we go into earnings season, but we'll continue to monitor it. All right, let's go over the agenda for today. We've got the daily market recap, talking technically, mailbag, chart lists, earnings spotlight, and the 3 you must see. But before we get into any of that, take you over to earningsbeats.com, where you can subscribe to our free Earnings Beats Digest newsletter. Simply type in your name, email address, hit that subscribe button, and we'll begin to send out our newsletter to you directly to your email box. It's published 3 times a week, Mondays, Wednesdays, and Fridays. It is absolutely free, no credit card required, and you may unsubscribe at any time. It's really just an educational newsletter. We try to talk about earnings, relative strength, and some of the things important to us at Earnings Beats. I think you'll find it educational and should give you some trading opportunities, or at least some trading ideas from time to time. So check that out and join our community. We'd love to have you. We also do a lot of webinars throughout the year. Many of them are open to the public, but we do limit it to those who are in our community. So that's another reason to subscribe, so that you're invited to our free webinars that we do from time to time. All right, let's move on and take a look at what happened on Wednesday. We did end March a lot different than we started it. The first week of March was horrendous for the NASDAQ. As you can see, we went down quite a bit, over 1,000 points on the NASDAQ in the first week of March. But to end March, we actually finished with a 200-point gain. So it was a nice little rally to close out the month. Hopefully that'll set us up for some good things coming in April, but we'll see. Time will tell there. The Dow Jones Industrial Average finished down 85 points. It did close back just beneath the 33,000 level. S&P 500 up 14 to 3972. Got very close to that 4,000 level for the first time in history. Didn't quite get there. Need to close above it. Honestly, I don't really like that candle today, where we got this nice little cup, little handle, and tried to break out and then failed. So we'll see what tomorrow brings. I will say this: historically, the first day of the calendar month is the best day of the calendar month. So the bulls have that going for it. As we open April, we'll see whether or not that helps us get the breakout. But if I'm just looking at the chart, don't know what time of the month it is, that does not really excite me, that candle. Now, it's just one index, but still, don't like that reversal. As I mentioned, NASDAQ up 200 points, 1.5%. So that's where we saw our leadership. Mid caps flat, small caps up about 0.25%, but both are starting to trend back higher above their moving averages. One thing I will say about the NASDAQ is that we were able to close back above the 20-day moving average after closing beneath it for 6 straight sessions. So baby steps, got to get to point A before you can get to point B. Technology up 1.6%, discretionary up about 0.75%. Those were the 2 best performers among the sectors. Financials, the worst performer, down 0.75%, but financials had been pretty strong. They still remain above the 20-day. I will point out that the discretionary group easily cleared both of its moving averages. A break above 170, I think, would be really bullish for this group. We do have another 1% or so just to get there, though. And technology managed to close above its 20-day, and we're going to look at technology in just a minute. Among the industry groups performing well on Wednesday, renewable energy and automobiles, blast from the past. These were 2 of the best performing industry groups in 2020, and they had taken a period off, as you can see, the renewable energy space, after topping in February, come down quite a bit. I mean, we were up over 400. We fell back to about 220 before rallying a little bit, but it's been a pretty rough period for renewable energy. But that's, kind of normal, par for the course for that particular area. It's extremely volatile. When it's going well, it's going really well. And when it's not, you can kind of see what happens to the downside. Automobiles, after a huge run in 2020 and into the early part of 2021, we've seen this group struggle as well. But notice both of these groups came up and closed just above their 20-day moving average. Now, they've done it before. We saw this earlier in March when we got a little pop to the upside. So no guarantees, but hey, you can't trend above the 20-day until you at least close above it. So again, baby steps. Moving on, let's go on, take a look at the, actually, before we even go, I want to take a look at the 10-year Treasury yield. That's one of the things I like to look at. So let's pull that up real quick. And as far as economic reports go, on Thursday, we're expecting initial jobless claims to come in at 680,000. Last week was 684, so we're looking for a little improvement there. We also have March PMI manufacturing expected to rise to 59 from February's 58.6 level. March ISM manufacturing expected to rise from February's 60.8 level to 61.4. But February construction spending is expected to drop 0.8%. January's increase was 1.7%. So looking for a little bit of a pullback there. But that's a lagging economic report. I mean, we're in the rearview mirror. We're talking about February. I mean, we're moving into April. So I don't pay too much attention to that report. But we do have a nice little cup here. I thought we were going to pull back. I still believe we'll probably pull back, as we tried to make the high in the 10-year Treasury yield on Tuesday. You can see that PPO is rolled over. So even with the strength today, we're still just kind of flatlining. I don't know. It just seems to me like we're running out of a little bit of short-term momentum here on the 10-year Treasury yield. And after the huge run, I mean, literally we had gone back and retested this 1% level at the end of January. So in 2 months, we've gone from 1% to 1.75%. That's a lot in a short period of time. So don't be surprised if we consolidate for a little bit. All right, moving on to talking technically. I wanted to go through and show you the NASDAQ chart here first. This is a 6-month hourly chart. And I thought this channel was worth pointing out. If you connect the highs from back in the middle of February, that's when we topped on the NASDAQ, and then you look at the last couple of moves to the upside and attempted moves to the upside, and then connect that with the highs that we saw on Wednesday, you have a pretty nice trend line. And when you grab that trend line and drag it down in StockCharts, you can exactly connect the lows using that same slope. So I think this is a pretty well-defined channel. Now, if I annotate this further, because different people will see different things. So that's one possibility. Let's get rid of that. And another pattern that I see here would be the highs being connected here. Whoops. Right about there. And then check the lows out here coming in here. So we got a triangle pattern off of an uptrend, which is bullish. Should we be, and you can connect however you wish. I mean, you can connect the intraday lows, the candle body lows, whatever. But this could be viewed as a triangle. So if we break out, not only would it be a channel breakout, but it would also be a triangle breakout off of an uptrend. These symmetrical triangles are continuation patterns. So maybe that's what you see when you look at this chart. One other thing you could possibly see would be something like this right here. Now I won't mark everything in, but here would be a left shoulder, left side of the neckline, a head, right side of the neckline, right shoulder, which came down a little bit lower than this one. And now we're starting to turn back up to the upside, a break above 13.6, And you could say we break out of a continuation, another continuation pattern, the inverse head and shoulder pattern. So there's a lot of different ways to look at it. But bottom line is, if we continue moving higher, it would be bullish breakouts out of all three of these patterns. Eventually, moving through 13.6 would be very bullish. I'm still 350 points away, but we went up 200 today. So another couple of days to start, if we have a strong start to April, who knows? But just wanted to point that out. Depending on how you look at a chart, you might be seeing different patterns. But I just looked briefly and saw those three. All right. The next thing that I wanted to share with you was the technology sector, because we have a very similar pattern here. Now, the only difference here is I couldn't, if I connected this high with these highs down here and show a breakout, well, if I drag that line, that sloped line down to this low, it would come down way below this low. So instead, what I did is I connected the lows and then I drug this line up here to this high and came across, and figure we need to get through 134, maybe even 135. That's the neckline right there. So you got 134 and then 135 is the neckline. We get through 135, that would be bullish for technology. And that's only, that's about maybe 1.6% away. Doing the math in my head pretty quick here. But wouldn't be a whole lot to get back up above that 135 level, 1.6%. We gained 1.6% today. So as we go into the early part of April, be watching for this, because defensive areas of the market do tend to lead in March. When April rolls around, we tend to see that money rotate back towards offense and away from defense. So as we're moving into April, if some of these patterns start to give way and start looking more bullish, I think that would be setting up for a pretty nice pre-earnings run to the upside in a number of stocks, especially in the technology area, and I would say consumer discretionary. All right, let's move on to mailbag. So the question I got in from a member was, would you consider McCormick's reaction to earnings a reason to sell the stock? So McCormick's reported yesterday morning, Tuesday morning, and you can see the reaction was very solid at the open and then pulled back. Now, I've got a couple of comments here. Number one, if you look at the group that it's in, food products, the group's been going higher on an absolute basis. But on a relative basis, this has been a very, very weakly performing group relative to the S&P 500. So I think you got to be a little careful whenever you're in a group like this. Now, McCormick's relative to the food products group. So we already know the food products group is not a great group. McCormick's is a relative laggard within that group itself. So you've got a poorly performing stock within a poorly performing industry group. That right there would tell me not to hold the stock in the earnings to begin with. I would not have been holding. Now, if you held and I got, if I was in and I got lucky and I got this gap up, I probably would have sold immediately at the open, just because, again, I don't have a great stock and I'm not in a great group. So I would have just taken that as a gift and moved to the sidelines. Now, the fact that it gapped up and is pulled back, the question is, what to do here? Well, personally, I think that there's still a lot of better areas to look at. I'm not a big fan of defensive stocks as we go into April. I believe we're in a secular bull market. There are going to be very few times I'm going to be overly excited about being in defensive areas during a secular bull market. So I'm not interested, and it's not something I would want. Now, if you're a little more conservative, then it could be more appealing to you. Now, would I consider this earnings reaction reason to sell the stock? I don't know. I like I said, I would have sold based on what I saw even before earnings. All right, let's keep moving on. I'm going to move on to ChartLists. And actually, let me back up for 1 second. Let's, before we even move on, I want to just show you a seasonality chart on the consumer staples area. That's where McCormick resides. That's where food products resides within consumer staples. So the XLP, when I compare it to the S&P 500 over the last 10 years, we've been in a bull market. Look at the outperformance of the XLP versus the S&P 500 during the month of March. plus 1.5%. It is historically, throughout this bull market anyway, it has been the best. March has been the best month for consumer staples relative to the S&P 500. Now, what's the worst month? April. We're getting ready to come out of a month where we tend to do very well with consumer staples and head into a month where we tend to do very poorly. So this is just another reason, but I do like to follow history, and history is telling me to be careful here. All right, now let's move on to the chart list. Sorry for the head fake. All right, short squeeze chart list. We updated this for members, and essentially what this is we look at, we put together a chart list of companies that have at least 20% of their float short. And right now there's 51 companies on this chart list. Now we can bring this up, view the list in candle glance, which is what I'm doing here. And so if I was looking to potentially trade a short squeeze stock, I mean, we all know what happened with GameStop and some of the other short candidates back in January. And what happens is you get a stock that makes a breakout. And then you've got all these folks that have shorted the stock. They've borrowed shares from their broker and they've sold borrowed shares. And when you start breaking out to the upside, your potential loss on a short sale is unlimited. When you buy a stock, the most you can lose is what you invest. If I buy Tesla and I put $10,000 into Tesla, if Tesla goes to zero, I lose $10,000. That's it. Most I can lose. If I were to short a stock like GameStop back in January, and let's say I borrow the shares from my broker and I sell $10,000 worth when it was at $10. If it goes to 500 like it did in January in a very short period of time, I could be required to buy GameStop stock back when it's at $500 if I don't cut my losses sooner. So all of a sudden I sell for $10,000, but now I have to buy for $500,000. I would lose $490,000. That's what short sellers are up against when you get breakouts. So when I start looking at these charts for short squeeze stocks, I'm not looking for these stocks that are downtrending. The shorts are getting it right, and that's fine. That's not helping me on the long side. What could help me on the long side is, and I'm looking here at Blink charging. So Blink has gone up to about this 42 level multiple times over the last month. And there's your 50-day moving averages at 42.98. Now, if the volume starts picking up and Blink moves back, say, through 43, 44, it could start to pick up very rapidly because shorts, especially anyone who is shorting in this downtrend, shorts could see that this is moving back up and they're starting to lose more and more money. And the only way they can end the pain is to buy their shares back. So what happens if they buy their shares back? They send the stock even higher. And then the next short has that same consideration. How much pain am I willing to take? So you've got to be careful on the short side in terms of your risk, because your risk is unlimited to the upside. And if you don't believe me, just ask anybody who was shorting GameStop when that went to 500. It took out hedge funds. It is incredibly powerful, and you don't want to be in the way of that. You don't want to be riding the wrong side of that freight train. You want to be on the train, not standing in front of it. So that's what I look for, any kind of move that looks like it's a breakout. So look at ASO. Here's one that's obviously been in an uptrend for a while, got to 2750, pulled back, and now volume's picking up, and it's back to this 2750 level. A breakout, and shorts will have a decision to make. And so that's what I would look for. It's not so much, honestly, it's really not so much about the fundamentals of the company. When you get a breakout and you've got a lot of folks on the short side, many times it's just a simple short-term market inefficiency. Nobody could ever convince me GameStop was worth $500 after it traded for $20 a few days earlier. Why did it go from that to 500? Because it was a stampede of short sellers that had to cover. They had to buy. So that's what you're looking for. You're looking for breakouts. I'm not trying to buy, stocks on that are heavily shorted on pullbacks. That's just making the shorts even more aggressive, perhaps on the short side. You're not going to get them to force themselves to buy if they're making money. The only time they're going to be forced into doing something is if they're losing money and those losses are beginning to mount. That's why you want to get that breakout. So anyway, this is one way that I would do, that I would look at it. I could just pull this up in a candle glance and just quickly look to see if I'm interested in any of these charts. Now, the other thing you could do is I set up this simple little scan, daily high greater than yesterday's daily max over the last 10 days, daily high. So in other words, if the stock is putting in a new 10-day high, look over the last 10 days. If today's high is higher than anything in the last 10 days, then it'll get picked up. And then I also added the short squeeze chart list. And I ran this scan. Well, I will run this scan. And let's see what we've got. So if I ran it today, 2. So of the 51 stocks on the short squeeze chart list, there's that ASO. That was the one I was just talking about. There are 2 stocks here that went to a 10-day high. These are the types of stocks that would start to get my attention in terms of a short squeeze candidate. So there's ASO. It's in the specialty retail group, the Fort Biosciences biotech stock. And, you may look and see that, hey, one of these industry groups is really starting to make a move to the upside. So if you've got a stock that's making a breakout in a group that's making a breakout, that could start to lead to more strength, which in turn will force shorts to begin to cover. So you could just pull the charts up, once you've run the scan, pull the charts up. Here it is, big move up, sideways consolidation, trying to make a breakout. Hasn't broken out yet, so got to be careful about jumping in too soon. And if you do play a breakout and it reverses and you get a false breakout, you got to be ready to exit because many times the shorts will get it right. Forte Biosciences, well, we've moved back above the moving averages. Volume has picked back up again. Still got some overhead resistance up around 40 to 42.5, but we're at 34. So maybe we get that run up into that area. So again, this scan is just alerting us to this, the possibility here. All right, let's move on to earnings spotlight. Only one company out after the bell that was significant at all, and that was Micron. And Micron, last time I looked, was up more than $3 after hours. So we were looking at $91 or so, maybe 92 per share. Nice report, though. They came out, they beat their earnings estimate, 98 cents versus 95 cents. So overall, pretty good, pretty nice beat there. The relative strength on Micron had been extremely strong up through basically the high at the beginning of March. And then it's come back down a little bit as we've been consolidating. But we're going to want to watch Micron. A breakout above 95, definitely 96 would be very bullish. And we'll see whether or not we can get that after we start trading again tomorrow after a pretty strong earnings report. Another company I just wanted to mention, they actually reported on Wednesday before the bell. So we've already had a day of trading, but we got a big gap up on Walgreens. And I even mentioned this on my show, Trading Places show over at the one I do at Earnings Beats on Mondays and Wednesday mornings. I talked about this and I said, if we get this breakout intraday and it fails, you're going to want to be a little careful, just short term. Because what I see here is a move up, nice little cup, false breakout. We could get a handle back maybe to test gap support in the rising 20-day moving average. But I do like what's going on here. I think the accumulation distribution is starting to pick up nicely. Relative strength has been very good of late. The drug retailers in general breaking out. So everything looks pretty good here. I just don't like that short-term candle. And if you need a little example of what can happen, look here. Now, this wasn't a false breakout, but it did leave a long tail to the upside, come back down, close near the low. And then look what happened. We went back, filled the gap, got close to the 20-day, and then turned back up again. So that's what I'm looking at possibly happening over here. All right, one more earnings related. This one's going to report on Thursday morning before the bell. So you probably, by the time you're listening to the show, You may have already seen CarMax, their report. But as I look at this, you can see the stock went sideways for a while, made a breakout in January on some nice volumes, been trending higher. Love the relative strength versus specialty retail. So I think all in all, we've got a pretty nice looking chart here with CarMax. I would expect good numbers. We'll see what's going to happen in the morning. But based on what I see on the charts, I think Wall Street is accumulating the stock. And so I believe we're going to get a good report on CarMax. The consensus estimate that I saw over at Zacks was for $1.27 on CarMax. So we'll see whether or not we beat that in the morning. All right, last thing we're going to do, the three you must see. And the first one I'm going to start with is MUSA. This was not a good performer. And you can see the reversal. See that bearish engulfing candle? Up, 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 everything going up, up, up. We gap up, we're trading up intraday, and then we reverse. That was Tuesday's candle. When you see that, it's a pretty good chance you're going to reverse in the near term. So today, what did we do? We went down another 4%. Now, the good news is I like the chart here. We've been seeing some nice relative strength of late. And if I annotate this one for you, the prior highs over here, we could see 142, 143, a little support. If not there, I would look for it on the 20-day. Maybe we go down to the 20-day tomorrow, reverse, come back up and hold that price support. But I do think in the short term, we may have a little bit more weakness, but we are getting closer to some support levels for a stock that recently broke out. The second chart that I have for you is SLG. And this is SL Green Realty. Kind of mixed signals on the stock. I mean, the relative strength's been pretty good. The group has broken out after going sideways for a while, but the group's relative strength has been very weak versus the S&P 500. And looking at SLG, we have been moving lower and lower with the AD line, and we're at a 52-week low. So it seems like whenever there's volume, we tend to struggle and pull back. And so I would just be a little careful, I think, with SLG just because of those, reasons. To the downside, I'm going to say 67 or so is about as far as I would give this stock to the downside. If it falls below that, I would exit. And the last chart I wanted to bring up, this isn't necessarily to trade, and I have a different format here on the chart. CTIC, which is CTI Biopharma. See, the stock went up 8.5%. The scooter, it was the biggest moving scooter to the downside. It went down like 49 scooter points with the stock going up. How's that happen? Well, one of the big factors in the scooter, one of the big contributors to the scooter is your 125-day rate of change. See how we were at 150%? Because as of Tuesday's close, it was comparing Tuesday's close to this low way down here. So it was 150% higher. Today, Wednesday, we went up, but now we're comparing this to the day after when we gapped up. So scooters don't always move down because of something that's happening now. Sometimes they move down because of something that happened 125 trading days ago. Understand the limitations on all indicators, and this is one of those for the scooter. All right, that's it for me. I really appreciate you tuning in. Join me over at Earnings Beats on Mondays and Wednesdays. Love to have you. In the meantime, have a great rest of your week. Enjoy your weekend. I'll be back next week. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.